Kristina, with the professor. I mean, he's obviously bullish. When I said 10 to 15% that Rick Reeder suggested, he didn't say, "Oh, that sounds ridiculous." What does it sound like to you?
It sounds like it can very well happen this year. I mean, clearly the trajectory is going to be up for stocks because we are going to see rate cuts. And it's not just about the Fed. We've got major central banks around the world that are going to be cutting this year. Probably starting very soon. And so I think that momentum is going to be a real positive for the stock market and will be supportive of, and of course with yields higher, I think we're going to be able to get some nice money coming from bonds as well. And this is an environment that I think is almost the antithesis of what I would call the annus horribilis of 2022.
I mean, we learned this week yet again that we're still sensitive to higher rates. You know, the Fed minutes, while backward looking, were hawkish, right? And, you know, yields didn't necessarily like that. And we had this big sell-off yesterday. So we're still really sensitive to the fact that rates are elevated. We're just going to brush all that off and just continue to move higher like you suggest and like the professor thinks we can too?
Well, we know that it's coming. It's just about timing. If you think about college acceptances, it's the difference between someone who gets in early decision and someone gets in off the wait list. They'll all wind up at the same school and they'll all graduate, presumably. And so I'm not so worried about the timing. I'm focused on the direction. And the good news is we've got momentum forming by having rate cuts coming from the ECB very soon. And I think the Bank of England, the Bank of Canada, that will provide some positive momentum.
Well, what if the direction? Let's focus on that. What if the direction leads you to a dead end? Right? There's the assumption that you're making that, well, the direction is lower for rates because the direction for the Fed seems to be cuts. What happens if we're wrong? I'm not suggesting hikes, but what happens if the cuts don't come for longer than we think? And I mean well longer than we think.
Well, then that's a time when investors should probably look to add to exposure in UK equities, European equities, areas that will benefit from those rate cuts coming more quickly. Also, of course, there's quite a robust carry trade that is going on right now because of bets around when we're going to see central banks start to cut.
Steph, how do you assess this week? How does it color your view on where you think we may go in the weeks ahead?
Well, I think yesterday it was a couple of different things. It was profit taking. We were up 6% in the S&P 500 in a month. So there was that. Then it was also this Fed speak all week long that really was more hawkish in terms of what they're going to do on cuts and the timing and maybe get pushed out and whatnot. And then I think the icing on the cake was the S&P Global PMI data that came in yesterday, stronger than expected, but also had higher prices paid index in it as well. So that gave fuel to the inflation staying stickier for longer. You know, I have been talking about, I don't think that we do need to do cuts, and I don't expect Fed cuts this year. And that's because the growth rate in the economy here is running stronger than expected. We're above trend. The Atlanta Fed tracker's at 3.5%. We also have global growth that's picking up. And I do think not only are we seeing the broadening here in the States in the S&P 500 and other sectors, but you also are seeing other places around the world that are offering opportunities. You know, I have been buying the Indian ETF, INDA. I think you add it all up, and in a 3%, even in a 2% GDP world in the U.S., that kind of translates, Scott, into about mid-single digits on the top line. But if the inflation continues to come down, which it is coming down, it's just slower than expected, then the margin story can stay intact. And you just did 10% earnings growth in the first quarter. You're probably going to do 8 to 10% earnings growth for the full year. That's very healthy. Earnings are going higher, not lower, and stocks follow higher earnings. So I'm pretty encouraged. I do not think we're going to be up another 15% from here, but I do think we are going to be up.